All right, good morning, everybody. Welcome to QuantBox Live. It's 6:32 on Wall Street, about 3 hours before the open of trading, and it's time to get our global macro on and uncover the best fundamental opportunities around the world. Things like sentiment, inflation, employment, GDP, technical trends. Yeah, all this stuff matters. Sentiment, yup. And we want to look at the long-term forces moving money around the world, but also short-term sentiment. What's happening here? What's happening now? Yesterday, the key part of yesterday's discussion here at QuantBox Live was the long term was risk off, the short term was risk on. You combine some technical analysis with that, and what you saw was technically we had a lower low, but prices had been rising for 3 days. But on the long run, it was down. So we talked about that. We said the long term forces are down. The vulnerability, of course, is that we go from short term risk on to short term risk off. We were short term long, but long term short. And the vulnerability was down, risk off. And yesterday, massive downward movement after QuantBox suggested that. After, hours after. So it worked tickety boo. Why? Well, because it's not guessing, it's not using an algorithm, it's not using any sort of like predictive, artificial intelligence. No, we looked at 6 different asset classes on 3 different time frames. So we looked at 18 different things and said, well, long term short, and long-term short it is. Wow, cool. So look, we use logic and intelligence. I happen to like logic and intelligence. I just happen to. I got my trader's hat on, and I'm working on that presentation. 27,804 patterns this year. And I can tell you quantitatively which ones work and which ones don't. I love that. 27,000. It's absurd, but that's why you have machines handle that, because a human could never do that. But anyway, so I like logic. I really do. It appeals to me. So again, we look at long term versus short term, and we do it every day. And from that, we can organize our thoughts so that our trading and investing becomes logical and intelligent. In the beginning, you'll bring some consistency to your trading. And then once you see positive results, it'll bring some confidence to your trading. And once you have a little bit, an ounce of confidence in what you're actually doing, well, you'll let your winners run. And that's when everything changes to the positive for you. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. I thought yesterday's presentation was so good that I immediately uploaded and immediately released it to YouTube, because we talked about logic and intelligence that pointed to the stock market falling tomorrow. And then 2.5, 3 hours after I uploaded the video, the stock market tanked. So there you go, YouTubers. At the bare minimum, subscribe to the YouTube channel. But look, it's time to get big, start trading like an institution, and pay the $79 a month. Let's log into the QB Pro. I am Groot. Yeah. Okay. Look at that though. Yields went up. I don't really like that. I don't really like that. Yields went up. Ouch. Oil has come down. We might even be changing the narrative now. Be careful because the Fed meetings tend to change these narratives. I don't know if today's Fed meeting will, but the pitch I gave a few days ago when oil was coming down was that the potential peace in the Middle East got rid of the risk premium on oil, and so oil comes down, not based on supply or demand. Well, it's come down enough now where maybe the narrative is changing in the market where like the recent GDP in the United States, which was last week, came out quite small. Like what was it, 1.6? It was 2.3 or something. Like when you get a smaller GDP, and now we're getting sort of mediocre projections from earnings season. Um, Investors in all kinds of assets, but in this case, oil or energy, they can say, well, future demand will be lower if, let's say, global GDP or yet US GDP or Chinese GDP is dwindling. So there's like the diminished future expectations might actually be trickling into this because we were significantly higher than this. We were 10% higher than this, and now oil's down. So maybe, I mean, I don't know. I can't just plug in and say, oh, well, it was this type of sentiment, but maybe that's what's also happening. Okay. So once again, we can step back and, if you're still a bull based on your outlook, see, imagine like people are getting out of oil or short selling oil because they have an outlook for the future. So, whatever your outlook for the future is, if you happen to be a bull, then stand back and let it fall. What do you care? If you're a bull, let it drop to $67 and buy it there if it stabilizes, right? So it's a symbiotic dance. You don't have to be on every trade. It's just do right? Left foot forward, right foot back. It's just wait your turn, bro. Okay. So if it's coming down to 80 or you do your technical analysis, find the prices in which you might be interested in buying. Right now it's bearish. Good. Get out of the way. It's a different attitude, isn't it? Get out of the way. If you're a bull and it's falling, well, just get out of the way. What's the problem? Okay, but anyways, it's coming down pretty hard. Yeah, what were we? 87? Now we're 80. Okay, 81. Okay, cool. Well, it's either a threat to you or an opportunity. You'll know if it's an opportunity. If you're a bull, it'll hit obvious support. And then on a small time frame, do a reversal pattern like, oh, I don't know, a double bottom. Yeah. So then you do the next higher high, higher low. Kick it off of a moving average like a 21. Just wait your turn. Okay. Cool. Gold. Okay, down a little bit. Um, so when we get to the risk gauges, I have gold going up is bad. And I score it that way because if you're buying gold, it's sort of an anti high inflation play. That makes sense. The other way of looking at gold, and you can score your gold gauge in your mind differently than me, because the other thing that could be going on is gold priced in dollar. So dollar strong when there's risk off. And so dollar strong right now. Notice that gold didn't do anything. Well, gold might have some buyers because um, inflation is persistently higher than the Fed would like. And that is changing the Fed policy, right? But at the same time, the stock market drops. So people are buying the dollar back. And so you see it's neutral. Like gold is neutral, but the stock market dropped like almost 2% yesterday. Like, so what's going on? Well, if you priced gold in different currencies, you'd get a different result, right? You see, like gold may be up priced in euro, but it's flat priced in dollar. And if it's flat priced in dollar, dollar's ripper strong yesterday, then by definition, so was gold yesterday. but just not priced in dollar. Gold is up, priced in Bitcoin. Okay. Remember, gold doesn't change really, right? An ounce of gold is an ounce of gold. But there's obviously some demand for it if the dollar was strong and gold is flat. So I want you to always think about that too. The pricing, the pricing matters. In this case, dollar and gold are neutral, so therefore they're both strong. Okay. S&P 500 bloodbath yesterday. Good. Remember, I'm short at 52. 52. Yeah, so that's all good. Triple leveraged. So yesterday we're down 1.5. At one point, I think that hedge was like 4%. Cool. We're back below 107. So if the stock market's down, dollar strong. Euro dollar down. Remember, we were at 107. At one point, we were like 109, if you remember. Okay. Stock market down. Dollar strong, euro comes down, gold is flat, so gold is strong. Oil is down, priced in dollars. Again, oil priced in euro wouldn't be down that much. And Bitcoin priced in dollars is also down. You see the correlation? So you get risk off, okay? Dollar strong to priced in Bitcoin. Think reverse everything. Dollar strong priced in Bitcoin, dollar strong priced in euro, okay? Dollar strong priced in S&P 500, right? Dollar strong priced in gold, but gold is also strong, right? Or dollar strong priced in oil, or vice versa, right? So you could have like oil, WTI slash USD, gold slash USD, right? You have to look at it like currencies. Okay. And so, anyways, there's no doubt when there's risk off, you should be bullish dollar. Okay. A lot of people mess that up, which is interesting. It sounds silly now if you know this, but it took me probably 6 years to notice that on my own. You know, as a bumbling idiot forex trader working out of his home office after giving up his wonderful, beautiful corporate job. You know, and it took me years to notice something as simple as that. Um, but anyways, I like to have the gauge now. It's quite nice. So with dollar strong, you're probably selling cat. Okay. With dollar strong, you're probably selling Kiwi. You're probably selling euro. You're probably selling pound. Ooh la la, right? Ooh la la. And notice Kiwi hasn't changed much. It's also negative. But if you have dollar strong underlying intrinsic trend, I would probably not go for the cross pairs first. If we have a global risk off scenario, trade the funding currencies. And then if your positions are so big, you're like, but I have so much money placed on the dollar pairs that more would just be risk. Okay, then do some cross pairs, right? So I normally would trade like Kiwi CAD if we were mixed, but if we're risk on, I'm buying dollar. Does that make sense? Yeah. Little things like that make a huge difference in your long-term results. You might not see it day to day to day, but the end of the year, if there's an underlying intrinsic trend and you're trading dollar, and then at the end of the year when there's no underlying intrinsic trend, you're trading cross pairs, then you're lining up your trading behavior with real market conditions that you can see now with QuantBox. On the long run, you are way better off. And I wouldn't suggest that you make more money. I would suggest you lose less money than you used to. Yeah. And when there's no underlying intrinsic trend, you'll probably trade less. So that you actually work less and lose less money. That's a good first step. Okay. Right. Yeah. That's a first good step. So, anyways, we're still intrinsically risk off on the long term. Okay. On the weekly basis or the weekly bias, yesterday was bullish. And I'm like, yeah, but we're at resistance on a lot of these charts. And that suggests that the weekly will roll back over to risk off and then everything will be risk off, right? The whole idea of lower high, lower low. Well, at least after one day into that analysis, we were correct. Are we going to be correct today? Oh, I don't know about that. Okay. My phone was on mute. I didn't get Jay Powell's phone call yesterday. I should have picked up. Okay. So I don't know. Um, but at least on the long run, you can say, well, there's a lot going on. The Fed meeting today and some of the other news this week, like non-farm payrolls, can have a massive impact on economic data and risk and positioning. That is true. But what we do know is the S&P 500 is down 4.5% for the month. That is a fact, Jack. Not good. Yen is still ripper weak despite all the volatility. This isn't a measure of volatility. In the last 30 days, is yen strong or is yen weak? It's weak. Well, that's good. Yeah, it's good. Now, it's weird to have that happen when things are currently getting bad, but we know this time around, yen is isolated. Normally you'd be right in risk off mode, you'd be buying yen, but we have a central bank intervention going on, and you can see it because that would not be normal in this situation. Well, now you can at least see it. So you're like, well, I don't want it now under these circumstances. Well, good that you're using the tool properly. Okay, gold is up. Again, I score this negative because I see if you're buying it, it's not aggregate demand, like everything is good, so everyone wants to own a gold watch. I score it negatively that if you're buying gold instead of something that pays you a high yield, like a 30-year bond or a 20-year bond or a 10-year bond, then there's something wrong in the market because you're like, well, I'm worried about the inflation eating away the real returns of owning a 5-year note. Because if you had a 5% inflation, you're not making any money. So maybe money is trash. Maybe money is worthless. Maybe you just want to own a bar of gold. Well, that's your attitude. Well, that's bad. Okay. All right, cool. Dollar is strong over the last 30 days, rolling 30 days. Not last month, last 30 days. That is bad. That's risk off. Okay. Yields are way up. Yields are up. You like paying more for your credit card? You like paying more for your house? You like paying more for your car? No, that's interest rates going up, but not the Fed funds rate, but the cost of borrowing money across the board over the last 30 days is up 10%. Gee whiz, what happened to that 2.5%, 2.8% inflation on PCE? And you're like, yeah, well, I track the treasury market. Yields are up 10% over the last 30 days. Well, that's bad. Money being more expensive is bad. Volatility is up almost 20% month over month. That is bad. Another way of looking at it, because it's not volatility the way you think, another way of thinking about it is that there's a 20% increase in institutional investors so worried about the stock market falling that they're buying insurance against that risk. And the stock market has fallen. They were correct. Okay, because month over month, S&P 500 is down 4%. Does it matter? Well, we were up 10% for the year. No, no, we're not 10% up no more. You see how powerful this is? So now you don't get kind of distracted and caught up with what's happening just today. Oh my God, euro dollar's up 62 pips. Uh-huh. You have to start like, what's the underlying foundation of your trading behavior? And so, like, just looking like I'm going from memory here, QuantBox, right, has been risk off for well over a week, right? Week and a half. But I remember last week, Thursday, the stock market started going up, but we expected it to go up even though we were bears. And then Friday it was up, and we expected it to go up even though we were bears. And then Monday, okay, Monday up, but we were at resistance and we're still bears. And then by Tuesday morning, we're like, oh my God, we're stuck at this resistance and we're bears, and it's been up for 3 or 4 days. Uh-huh. Down. Collapse. Good, because we were not fooled, because we have the data. Nice. Remember yesterday? Wasn't it yesterday? I said, look, you got to stand for something or you'll fall for anything. Cool. That's why you're like, I'm a bear and I'll stand my ground, or I will get out of the way. Okay. If you read The Art of War, there's an honorable and a dishonorable way to win or lose in military strategy. Okay. If you fight a losing battle and you lose a lot of, troops, in this case, your troops is money, um, in something that you never had an advantage in, then it's a very dishonorable loss. Okay. Anyways, Bitcoin devastated. Isn't this interesting? Remember, over the last, maybe over the last week, I've been talking about the release of spot Bitcoin and Ethereum ETFs in Hong Kong. And I was comparing comparing to the release of spot ETFs in the United States. When ETFs in the United States came out, price dropped like 15-20%. And then what doubled? Okay, cool. And then what? So now we get to the Hong Kong issuance of these spot ETFs, and what happened? The stupid thing dropped like 20%. I'm like, cool. Is it going to be a repeat? Wouldn't that be interesting, huh? So Bitcoin's way down for like the third or fourth day. We broken through some support that I had outlined, I don't know, 3 weeks ago. And so it's a massive, like, look at this, just bloodbath, 7% decline so far today. And yesterday was bad. And the day before was bad, like a major thing. And all wrapped around a new release of ETFs in China. So um, the ETF, the price of Bitcoin dropped on the ETFs in the United States, and then all the money went in. I don't know if it's people pushing it down or like someone's playing the game, I think, but whatever. Prices dropped, all the money went into the ETFs, and then Bitcoin doubled, like, or 50% or whatever it was, a huge new rally. And so again, the thought is, if the United States institutional investors, think of it that way, this is why it's important. Okay. If institutional investors are able in the United States are able to buy spot Bitcoin now, and now in China, institutional investors are able to buy spot Bitcoin, then it really opens up the market. It's really becoming global. Um, do you buy into that narrative, or is that nonsense? But if you do buy in, you love these 7, 8, 9, 10, 12, 15% drops. You love them. Okay. But you have to be the person that says, Well, I see that it's dropped 15% and it makes me happy because I'm a buyer. So if it drops another 15%, just get out of the way. Right now, it's fallen 7% and QuantBox actually has a negative score on it. So wait your turn. Find your Do your technical analysis, find your lines in the price time continuum. What price do you like? 60, 55, 50? Just do your technical analysis or wait for QuantBox to flip. Now, this is why having the alert service of QuantBox is important because it'll either email or text you that it flipped. You'll get a message like, "Hey, Denise, did you notice Bitcoin turned bullish again fundamentally?" You're like, "Really?" Yeah. For me, it always tends to happen while I'm in the middle of doing dishes and my hands are wet and soapy, and my phone goes blink, 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 and I'm like, oh my god, it takes me so long, and then I can't open the stupid unlock the phone, and right, and then I got to run to my computer. Yeah, um, but that's another way of handling it. But I would combine both technical and fundamental analysis if I were me. Okay, and as a reminder, okay, this is really the basis of the brain of the alert service. That's the upgrade to QuantBox, and because this is the sum. Oops, the sum total. If I can type this out, the keyboard's right over there. The sum total of all the other things like the scorecard summary and the technical trend. Right. This is and QuantBox went bearish on Bitcoin 2 weeks ago. What? You're like, what? Yeah. Well, okay. Yeah. Yeah. So, what was the price when it actually went bearish? 65,750. 65. Yeah. Yeah. So, somewhere in here, probably this. No, that was 70. So, on what was it, the 13th? Well, yeah. Let's do it this way. 13th was right here. Oh yeah. Oh yeah. Okay. Now maybe things are changing, maybe, but right now it's still neutral. We're caught. Maybe it's going to go up. Maybe it's going to go down. Okay. But this is primarily fundamental. Only a small part of this analysis is technical. Only a small part. But part of the analysis, technically, of course, well, and I keep making this point, it's not actually technical analysis. TRADARS does technical analysis. This is doing statistical analysis of the price. So it's calculating the average and the slope of the average and doing linear projections. And okay, negative. So anyway, so it gets a negative one. Negative one is hardly anything, right? So anyways, look at that. Isn't that neat? So you could sit around here and wait for a flip from negative one to maybe plus one, plus two, plus three, and it's game on again. Okay. But after today, it's probably not so good. But isn't that nice to be able to go back and check these things? Yeah. And also for those that have trouble forming a bias, well, this is it. It just did it for you. Okay, it's done. You're like bearishly neutral. Okay. Okay, cool. Bearishly neutral. Okay. The 200-day simple moving average is at 49,000. Okay, check this out. The 50-day average is above us. The 200-day moving average is below us. This is the neutral zone. This is suggesting that if this continues, the next target is 50 grand, 50K. Yeah. Another $7,000 drop is not probable or likely, is possible. Cool. So the next question is, do you buy it there? Well, that's for you to figure out. You get that right, you have a career. All right, so let's look at the eco calendar. And okay, well, at 8:15, we have our ADP, another dumb prediction. Some feel this predicts what happens non-farm payrolls on Friday. I actually quantitatively studied this many years ago. Literally, Kurt Worley, the quantitative analyst at fxbootcamp.com. I said, "Hey, Kurt, can you figure this out for me? Is this true?" Because I heard it all the time on TV. Well, with ADP being so good or so bad, therefore non-farm payrolls will be. I'm like, okay, that makes sense, but is it true? What a dumb question. Makes sense, but is it true? So I said, hey, Kurt, who has he's passed away now. I said, hey, Kurt, you have a master's degree in applied statistics. He's a quant. Think about how far back we've been doing quantitative analysis, right? I'm telling you, 20 years ago, doing quant stuff, right? So, anyways, I'm like, is it true? And the results were no positive correlation, no negative correlation, just no correlation on the long run. Now, things radically changed around 2008 because everything's manipulated by the central bank and the central government. And so, well, when you're pouring trillions of dollars into a dead horse, you're propping up the dead horse. So all of a sudden all the correlation broke because the government was like just again adjusting. When I say manipulation, some people say it's like I mean bad. I'm an economist. There's no good or bad. Okay. There just is. So all I know is we didn't have any correlation in a free market. And then suddenly we have a central government stepping in and or a central bank stepping in to support or cool off an economy through all these different things like pumping liquidity, trillions of dollars in the market. And when they started that, it broke the system. And now, of course, if you're pumping trillions of dollars into the market, but not the market, the government, then what happened was, of course, people were getting jobs. People that probably weren't even qualified for jobs were getting jobs. And then we found out after they got the jobs, they were very unproductive workers, right? So it was really funny. Like it all makes sense, but we lost the correlation because we had this money coming in that didn't exist before. The economy didn't create the money. We borrowed the money or printed the money. So anyway, so then the correlation broke down. But when I see signs like that, like if it is true now, ADP does predict non-farm payrolls. I still don't trade that way because they're completely different math, measuring different data sets. So they're similar but different. But I look at it, if there is a correlation, I know it's a sign that the system is still broken. I'm a free market guy eventually. Eventually. I mean, look, you need rule of law and all that kind of stuff, but I fear unintended consequences more than anything. So anyways, so we got our ADP And then we got some PMI manufacturing dismal numbers. This is flat, and I reviewed this actually yesterday from last week's PMI, which was preliminary. Um, but do you know what the numbers are in Europe for manufacturing PMI? So anything below 50 is contraction. And normal would be 51, 52. It's chugging along, and we know the United States is not a service economy. It's a or isn't a manufacturing economy. It's a service economy. So we know this won't be great, and just ever so slightly contracting. So really flat, right? No growth in that industry. In Europe, it's like 42, 43, 44, 45. Like that's extraordinarily bad. If really good is 52, then really bad is 48. But if you're doing a 43 in manufacturing in Germany, and Germany is a manufacturing economy, then it's recession. And a nasty one too. Like, wow. And I always say, like, if Germany is pulling out a manufacturing PMI of, let's say, we'll call it 47, that's a bad number. It might actually be worse than that. But think about it. What does it mean if you're measuring manufacturing and Germany produces Volkswagens and Audis and Porsches and what am I missing? I got the Porsche, I got the Volkswagen, Audi. Well, I'm missing one, right? Anyways, they produce a lot of cars, and so wowzer. Okay, if they're not producing cars, it's a red flag because oh, thank you, Mercedes, BMW, thank you. You know, yeah, the one with no buttons and the one with tons of buttons. Yeah. So that's a lot of different car manufacturers, right? And it's bad for two reasons. There's no work for Germans that make all these cars. That's one thing. The second thing is, how come nobody's buying these cars? And it goes back to, well, the Fed funds rate. And so when you analyze the United States market, as I did yesterday, I actually read the PMI report and the PCE report. By the way, big shout out to investor boot campers. Like, we actually read this. You know, it literally says in the United States, demand for vehicles are down significantly. People in the United States are not buying cars, which include Porsche, BMW, Mercedes, Volkswagen, and all that kind of, and Audi. By the way, it's all the same car. Volkswagen Touareg, the Audi whatever SUV, the Porsche. It's the same car, and then even the Lamborghini Urus. It's the same as the Volkswagen Touareg. I have Lamborghini parts on my Porsche, which is really funny. But you can also have a Volkswagen part on it too. But anyway, same car. But nobody's buying this. Why? They cost too much to lease or borrow the money. So if you need $120,000 to buy one of these vehicles, even a Touareg is 75 grand for a Volkswagen. Most people, I think, don't have that kind of cash. So they go and they're like, I want to lease it or I want to borrow, finance it, right? Not at 8%. So, anyways, this is tracking back. We are seeing this. Okay. And so what I did yesterday is I analyzed the PMI in the UK, the PMI in Europe, and the PMI in the United States back to back to back, and read all the reports, and you can see where the trouble is. And definitely the auto industry is in trouble, and Germany is in recession by that measure. Hey, isn't it nice to actually read the reports and actually know stuff? Yeah. Look, Someone's got to be the smartest person in the room. It might as well be you. And the only way to do that is to do the work. Farmers get their hands dirty. Have you ever seen farmers' hands? They're like meat hooks, right? They're huge fingers, calluses on top of calluses. Do you know why? Because farming's hard work and you get dirty. So if you're going to be a trader and an economist, you got to get dirty. You got to get into the weeds. You got to do the work. You can't just dream about being a millionaire. I got a private jet. I got a private island. Beautiful people love me. No, you got to get dirty and do the work. And QuantBox helps you. Okay. So, anyways, okay, we'll look at some of these. One is output and one is productivity. And then jolts. Okay, that's great. That's great. How many um, advertisements are there for jobs? Are they going up or are they going down? Okay. So we expect this trend to continue. There was 8 million, okay, 760,000 jobs advertised. And we expect a little bit less, and that's on trend. Okay. And that means they're coming down, and that means less and less demand. Okay. And then this afternoon at 2 p.m., the Fed meeting, the announcement, and the press conference. I've scheduled on Forex.today on the YouTube channel. I scheduled a meeting. So if you want to swing on by youtube.com/Forex today, and we'll take a gander. We'll sit in the room like a fly on the wall and actively listen to Jay Powell actively not tell us anything. Yeah, and the UK government will measure that not happening. All right, cool. So I think we'll leave it at that. We covered a lot of the on the fundamental side, and then obviously this is a economic time bomb, maybe, right? And so this is going to like suck up volatility and liquidity until we get there. So I'll leave you to do what you already want to do. And so just the parting comments, if you're trying to figure out what your bias is, you can use the historical backtester and say, should you be buying uh um okay under an underlying intrinsic trend, should you be buying or selling Aussie dollar? And this will clarify. It's quite bearish, but it used to be more bearish. But you're definitely a bear. So that just helps. Like you're like, I don't understand all this economic data. Well, dude, QuantBox does. Okay. So you can look at it and you're somewhat bearish, but you're definitely not bullish. There's nothing in the world that could get you to buy Aussie dollar. You're either going to sell it today or you're not going to sell it today. And the decision is technical, not fundamental. This is fundamental. That's one way. And it's pretty, isn't it? Yeah, it's pretty. The other way to organize your thoughts is this. Okay. And maybe use these in conjunction. You're like, okay, these are the scores, but I'd like to see the other one. So you set up like maybes. Okay. You set up your list. What do you call it? The watch list for the day. Euro Kiwi, but we have a trend going on with the dollar. So you could ignore that and just say, well, today I'm more interested in dollar. Okay, bullish dollar CAD. Okay, this is a cross. Okay, maybe not today, but you'll keep an eye on it. The DAX, well, if we're moving risk off, owning the stock market's not right. So you're still doing a little bit of here. Okay. Okay, you might be interested in dollar and the risk off because the risk gauge shows you would buy dollar during risk off. Okay, so maybe today USD Swiss franc. Okay. Maybe today USD yen long. These are just all bullish. Maybe USD rand long. Maybe. These are all your maybes. And then you can go to the back tester and see how how that influences you. And then after you do that, you go down here to the bearish side. So maybe you'll sell Kiwi dollar today in a risk if it remains risk off. Now today we might just lose volume and volatility. Nothing really happens, but it won't change anything economically. Maybe you'll consider maybe selling pound dollar today. Maybe, just maybe, you'll consider selling euro dollar today. Remember, only if you find it up at resistance. Bear sell green candles, right? So even on a 15-minute chart, you need some up. You need to get resistance, so a lower high, and that predicts a lower low. So you combine your technicals with fundamentals. And so I've seen people that even go through, open their charts, open up Kiwi dollar, and actually write on the chart very bearish. QB equals very bearish. Then you sit there looking for technical analysis for bearishness, or you use TRADARS to say, you're watching TRADARS, and you're only looking for Kiwi dollar, pound dollar, euro dollar shorts. If TRADAR sees long patterns, that's your opportunity to get out of the way because they exist. TRADAR sees them. Doesn't mean you trade them, but they exist. Someone else will trade them because they're bulls. So get the heck out of the way. But if you're sitting here and then TRADARS sees patterns, then the patterns exist. They're real. And if it sees bearish trade patterns and QuantBox is bearish, get on the gravy train and let the sucker run. That's how you do it. Peace on earth. May the pips be with you. May your profits be above average. I'll see you at 9 and I'll see you at 2. Go get them. But be careful. Remember, we may lose volume and volatility. There's actually a lot of news on the calendar today. So we might have the volume, but the volatility may not be consistent. AKA, be careful for chop. It could be choppy. Have a wonderful